how we can utilize the moving average for our trade decision, how we can utilize the moving average for our trade decision. So different type of moving averages are used in the technical analysis: simple moving average, exponential, displaced, time series, triangular, variable, volume adjusted, weighted. All these different types of moving averages are available in the technical studies. So out of all these studies, I'll be giving you the displaced moving average, which is very much accurate for intraday trade and it maintains a great accuracy. And this is also gives a good view for the next day move, means displaced moving average helps you to identify the next day trend from the today's closing price also. So there are different approaches of using this concept, and any one concept you use, if you trust on that concept, if you sincerely use that concept, definitely it prove fruitful to you. If you do not use that concept with a proper essence or with a full trust on that concept, so you may not get that proper benefit. So before starting the session, I'll just conduct a small survey. I'll ask whether moving average works. How many of you trust that the moving average works? How many of you say that no, it never works? How many of you say that yes, sometime it works, sometime not? So how many of you say that if it is implemented properly, it works? So this is a view, because once you are going to learn that concept, you must have a trust on that concept. So here currently in the room 190 people are present. Out of this 190 people, 29% says yes, it works. 39 to 40% it says that sometime it works, sometime it not. 30% says that it works if it is implemented properly. 2 to 3% people says that it never works. But your experience will change. Once post this program, your experience is going to change. So fine. So this is the view of the webinarians today. Majority of the people says that sometime it works, sometime it not. Next majority of people says that it works if it is implemented properly. Third priority goes to people those who are very much confident and they say that yes, it works. So this is what the poll result. So that also I have shared with you. Now moving to this system of our moving average, I'll now discuss what is the mathematical calculation behind this moving average. So here we take the closing prices or the last traded prices. If I take say about the simple moving average, then what happens for simple moving average of 5 period, whenever I say, so past 5 days last traded price or closing price you will be taking, adding it together, divide it by 5. Suppose if I am telling that this is the moving average you can find for 5 period. So all these 5 days last traded price or closing price you will take, add all the things, divide it by 5. This is just an average. So this is called simple moving average. If I say 10 period simple moving average, that 10 last traded price you will be adding, dividing it by 10. So what makes the sense here? As a trader, simple this addition and subtraction, why it works? Why it works? And those who say that it never works, why it didn't work? So here the question is, whenever we are finding out this average of a price, we are concluding to a stage wherein we are saying that most of our or the majority of the traders, those who have bought into this company or sold into this company, has executed the trade at this 569. So if I am telling that simple moving average 5 on 8th January, this date. So this says that though the trade has happened from 2nd January to 8th January, however, majority of the traders has executed the trade at 469 rupees and 71 paisa. That is the meaning of a 5-day simple moving average. So similar meaning for the 10 days simple moving average also. So whenever we are going for exponential moving average, the approach little changes here. So first we have to find out a simple moving average. Suppose we are going to find out a 5-period exponential moving average with a set of data whichever is available in our hand. The first average will be a simple moving average because 5 periods we have to add, divide by 5. Then we have to use a formula. For the next day onwards, we have to use a formula. Current closing price, whatever the current closing price is here, this one 454.95 minus previous period exponential moving average. So this is the previous period exponential moving average. So first case it will be a simple moving average multiplied with smooth constant. Smooth constant is nothing but 2 divided by 1 plus n, where n stands for the number of days. So it is 5 period means 2 divided by 1 plus 5, so 2 divided by 6. So this has to be multiplied here. So this entire result has to be added with the previous day's EMA. Previous day's EMA. So if I can say here current closing price will be utilized. Previous period's exponential moving average, if it present, it will be utilized. Or if it is the first period, then only the simple moving average will be utilized. Added with the previous period's exponential moving average, and smooth constant is 2 divided by 1 plus. So when we compare between the exponential moving average and simple moving average, exponential moving average gives you a more accurate result as compared to the simple moving average. Reason why it produces a more accurate result? Because of this smooth constant, because of the parameter adjusting. So this is called your first parameter adjusting component. So because of this smooth constant and parameter adjusting, or the price oscillation shifting, many meanings are there for this part, first part. Some people used to say that, some analysts used to say that it is axis shifting. Some people used to say that it is parameter adjusting. So whatever may be the meaning. So because of this first part, this produces a little accurate result as compared to the simple moving average. So that accuracy varies in between some 20 to 30% as compared to the simple moving average. So now how we can utilize this moving average for our trade decision? So here certain conclusions we used to derive after this calculation. The first conclusion is, if the short-term moving average is higher than the long-term moving average, then the trend is up. Short-term moving average means we have to take a 5 period and 10 period. Then we have to compare. If the or 5 minute or 5 candle and 10 candle, whatever is feasible. So if the 5 period moving average is higher as compared to the 10 period, then we should say that trend is up. If the 5 period moving average is lower as compared to 10 period, then it is called as the trend is down. Sometimes this 5 period and 10 period moving average used to be equal also. So that time we used to say that trend is neutral. We need not have to, we have to wait for some more time for some clarity on the trend. And here you can take the 5-minute closing prices to derive the moving average. You can take 1-minute candle closing to derive this moving average, whatever is feasible. And for the positional trades, Short-term positional trades, we used to take 5 days, 10 days, or 10 days, 30 days, or 30 days, 60 days, or 2 months and 1 month. So these are the periods we normally take to derive the trend or trade decisions for as a positional trader. And this is about the exponential and simple moving average. When it comes to the displaced moving average, the approach is entirely different. So here the displaced moving average, first we have to find out a 3-period moving average, that is simple moving average. Then we have to find out a +3 or -3 displaced moving average. Very rarely people use this moving average. Most of the softwares which is standardized in the market never has this facility of displaced moving average also. But this is a fantastic moving average and much more powerful than the simple moving average and exponential moving average to identify a trend and to trade forecast, because this also uses the Fibonacci ratio into it. So here the same displaced moving average 2 by n+1 approach is being followed, and once you have found out the 3-period moving average, then you have to use the Fibonacci ratio to take a buy entry and sell entry. So that I will explain it in a Excel sheet. So here we'll move into the Excel sheet. Those who have not registered for the 2nd week, 3rd week and 4th week of this event, please register, and the registration links you will find out in our website under seminar link. The data points from 27th August to 30th September for this Nifty future data I have taken. So this is the high, low, open, high, low and the last traded price of this Nifty future. So whenever I am finding out the 5-period moving average, Excel you have an average column equal to average, just to drag this thing you will get the 5 days moving average, simple moving average. Similar way you can find out the 10 days simple moving average. While calculating the exponential moving average, as I said, your first data is nothing but your 5 days simple moving average. Second data will have a factor called 2 divided by n+1, where n is 5 and 2 divided by n+1, and this has to be multiplied with the difference of the current day's closing minus the previous exponential moving average, and the net result will be again added with the previous day's exponential moving average. So we have calculated 5 days exponential moving average, 10 days exponential moving average. We have also calculated the 5 days simple moving average and 10 days simple moving average. So now we have to derive the trend. So if you just look into this column, so 29th September, here we have closed, and this part, so I will be just coloring here. So this is your 5 days exponential moving average. This is your 10 days exponential moving average. I have taken a spread, means difference between these two things. 5 days minus 10 days. So that spread concept I will tell you later. So here, after finding out this 5 days exponential moving average and 10 days exponential moving average, it is clear here. As per the 29th September closing, it says your 5 days exponential moving average is lesser as compared to the 10 days exponential moving average. So trend is down. As per the closing basis, trend is down. So at what price this trend is going to change? That is more important. This is already happened. This is already closed. The trade is finished for the day on 29th September. So how I can utilize this particular data to forecast the trend for the next day, which is going to happen on 30th September. So what I will be doing here, this is the open, high, low close all data I am having. So I'll just change it here. So I'll change the values here so that I'll come to know at what price point this 5 days exponential moving average will move above this 10 days moving average. So I have changed from 7859 to 7900. So I have found out that okay, this is 7885 and 7889 still lower. So I'll change it to 7910. Still it is lower. 5 days is 7888 and 10 days is 7891. Again I will change it to 7915. I do not use any software now. I am just utilizing this particular things to estimate the next trend. So 7920. So 7920, it is just par, it is coming to 7892 and 7893. So now I'll take to 7925. So whether this gives me this also little closer, it has come 7930. So it has come to, yes, at 7930 level, or I can say 7927. 7927 also 3440. So 7929. So the precise point is 7929, above which my trend is up. So as per the closing, my trend was down. 7859 as per the closing price or last traded price of 29th September, my trend was down as per the exponential moving average. So I need to know when this downtrend is going to change to the uptrend. That is what my expectation is. So now this downtrend is being changed to uptrend whenever this price will touch 7929. This is just by changing the prices of 29th closing prices or last traded prices. I found out that yes, this is going to, the trend is going to change once we cross 7929, because at that point only my 5 days exponential moving average will be above the 10 days exponential moving average. Short term moving average will be above the long term moving average, so my trend will be positive. Once this trend is positive, then when this trend will become negative, or when this trend is going to become negative, or when this trend is going to a point where I can just say that yes, the trend has matured and I need to do something to means come out from this trend. So to know that, so we have to take the spread difference. So whenever we have taken the calculated this 5 days and 10 days exponential moving average, we have to take a spread here. What is a spread? Spread is nothing but the 5 days minus 10 days. So 5 days exponential moving average and 10 days exponential moving average. So here, after finding out every day's spread, we have found out the maximum and the minimum. So maximum spread, what we have given in the Nifty future, 34.33. Minimum spread, it has given us 60.5. So now we have to simulate this price. So we have concluded here above 7929 trend is up. Now I have to see when this trend is going to saturate. That is my objective. So I will be changing here 7950 because I need a spread which is near to 34. 7950. I can go to 8000. I can go to, now spread is coming to 11. So I can go to 8050. 8050. So my spread is 18. So I can go to 808080. So spread is 23. So I can go to 8100. So spread is 26 now. So by like this way, I'll go on simulating 8125. Spread is 29 point something or 30. So 8135. So 8135. So it comes to 31. So I can say that 8150. So spread is 33, close near to that 34. So I can say 8153. If I say it is 34.18, very close approximate. So trend is going to trend uptrend. This trend is up. So here we can say uptrend. of trend having a saturation at 8153 as per this 5 days exponential moving average and as per the 10 days exponential moving average. Similar logic also you can implement in the simple moving average. Similar logic also you can implement in the simple moving average. So to summarize these things, I can say first you have to find out the most recent 5 days exponential moving average and 10 days exponential moving average. You have to see where the trend is currently now. Post which you have to change the last trade price of the last record or the last data point you have to change to find out where your trend uptrend is giving you a confirmation, means 5 days exponential moving average is moving above the 10 days exponential moving average. Then again you have to go on simulating to find out the price point where your maximum spread is having a coincidence with the maximum spread equals with the past maximum spread difference. So that will be your trend saturation point. So between this 7929 to 8153, this is the price it is going to move. Then it is in your domain to use the Fibonacci principle or to Elliott principle or the W-Degan principle to find out which are the important resistance points will be there, which are the important support points will be there. So utilizing this particular moving average, you do not require a sophisticated software. You just need to simulate that things in a Excel sheet, and then you have to change these price parameters to observe where your trend is going to give you a confirmation. So now moving to the next part, displaced moving average, which is highly useful for our intraday trade decision, where we are utilizing the Fibonacci principle along with the moving average to identify the trend points and entry points. So before going to that particular section, I'll take a couple of seconds of your time to make you understand our smart finance products and services. Smart finance has 10 different products, and the concept what you are learning on this technical analysis course, this covers most of our moving average concepts, indicators, oscillators. So this is a course having a book and 3 DVDs, and we have simplified to the maximum extent. Tomorrow also you are going to experience that how the trend continuation pattern you are going to observe without the help of any sophisticated software, in a more simpler manner. Tomorrow you are going to experience that concept, and today you are experiencing the simple moving average, how easy this particular concept to implement in your study. So those are the concepts of your moving average, concepts of your oscillators, indicators, everything in its simplified manner, in its original mathematical manner we have given in this technical analysis course. And likewise we have different courses along with the softwares, and these courses if you take individually, altogether it comes 47,000. If you take at a package, it comes at a price of 17,500. Any product related query you can call in this particular number, and these prices whatever I have told, this is the price applicable now as of today. So this price may be get revised in future time. So if you are seeing this video in some future dates, maybe that time prices will be different. So this is the sales numbers is being given. So if you want any product related information, you can call there. utilizing this displaced moving average for our intraday trend forecast. And this is, as I said, this is a method of highly useful for intraday trade. It may not be much useful for your positional trades. So while utilizing this particular concept for intraday, you require the 3-period simple moving average or 3-period displaced moving average you require. So for this, what we are taking, we are just taking the 28th August to 30th September, this data we have taken. We have taken the close last traded price of the Nifty future, and we have taken the 3-period moving average, just added last three prices divided by 3. And we have also taken the 3-period exponential moving average, because simple moving average we have to calculate, then only we can able to calculate this particular exponential moving average. So we have taken 3-period simple moving average, 3-period exponential moving average. Now we have to calculate the displaced moving average. So displaced moving average said that whatever the exponential moving average you are getting, that added with n divided by 2 divided by n plus 1. So 2 divided by n plus 1. So here n is 3. So 2 divided by 3 plus 1. So 2 divided by 4. So which is coming to 1 divided by 2. After solving the equation, 1 divided by 2 is nothing but 0.5. Multiplied with the same 3-period exponential moving average and divide by 100. Means whatever the 2 divided by n plus 1 percentage of the 3-period exponential moving average you have to calculate. So this is nothing but the 2 divided by n plus 1 percentage of which value? Percentage of your 3-period exponential moving average, EMA. So this value, once you get added to the 3-period exponential moving average, you will get displaced moving average plus 3. Similar way, once you subtract that value, you will be getting the displaced moving average minus 3. So displaced moving average minus 3. So here we have just taken the displaced moving average minus 3. So this is how we have calculated the displaced moving average. So here is you are taking 3-period exponential moving average 0.5 subtracted from that same percentage value. So after finding out this displaced moving average of plus 3 and minus 3 points, we have to calculate the buy entry and sell entry. That we need to calculate utilizing our Fibonacci retracement. So how we can utilize this Fibonacci retracement along with this? We have to take the 3-period exponential moving average. Then we have to take the Fibonacci ratio percentage. Here the ratio utilized for buy entry calculation is 0.382. So 0.382 multiplied with this value of plus 3 displaced moving average divided by 100. So similar way sell entry. Once you are calculating the buy entry and sell entry, so maximum buy target and maximum sell target, you can take it from the growth retracement, which is 1.618. So this is how it is calculated. 29th September this has ended, and you can say that here is your buy entry and here is your sell entry for 30th September. So this is your buy entry, this is your sell entry. So all these calculations we have done. So it has opened at 7929, 30th September. It has opened at 7929 and it has gone till the low of 7894. Our stop loss sits at 7863. So do not count the points between the I am entering at here 7924, my stop loss is at 7863, risk reward is very high, this that. So by looking into this risk reward only, you are losing more. So most of the things, because we dilute the principle which is convenient to us. So this value comes through one calculation. But many people after listening this thing, they will say that if I buy at 7924, so what will be my stop loss? I will say 7863. Yes, this is coming as per our calculation. then definitely they will argue here. If I put the stop loss here, my risk reward comes to 60 points. So this 60 point is not being put by me. What is the meaning of a stop loss? Where the price trend changes. So everyone will be agreed with this particular point. Whenever I'll ask you what is the definition of a stop loss, many of you will say that the definition of a stop loss is where the price trend changes. So herein price trend changes at 7863. To please your mind, if you are saying that no, I will buy at 7924, but I will keep the stop loss at 7900. So this will please your mind. That is not based on any calculation. So here, as per this particular principle, it has come 7924. If you are buying, this is the stop loss, and maximum target or growth retracement target is 1.618. And I have also used other Fibonacci ratios here. I have used 0.5 Fibonacci ratio. This is also 0.618. This is also 0.786, and this is 1.236. And already you are having 1.618. If you see today, what happened? You have opened up here, gone till 7894, no stop loss as it. Your 1.236 100% retracement you have achieved here. 100% retracement you have achieved. 100% retracement level is coming. So if I say 100% retracement level, where it is coming, so you can say 100% retracement level, so 100% retracement level, if you can say, it comes at 7972, and this is one of the growth retracement level, which is 1.236, and you have gone till 7889.8, and which is very close to 7991. 1.236 retracement level you have gone. You have opened at 7929, then you have retraced back, consolidated in that band for a period of time, then you have again given a breakout, and no point of time you have gone to the stop loss point, and you have achieved a matured trade till 1.236 retracement. Similar kind of experience you can get if you just utilize this particular concept in Bank Nifty or any stock or any of the commodities. So this is a simple, very simple concept, wherein we are just taking the displaced moving average, utilizing the Fibonacci 0.382 retracement for identifying the trend. So this is for this data, 7882 above trend is up and 7872 below the trend is down. This is already a trailing indicator. This prices has already happened, and this information I got. But what is the use of this information? What is the use of this information? The information what I have got using this exponential moving average, what is the use of that? Because I must be in a position to use this concept for my trading, then only I should learn it. So here I differentiate. Here I brought my own innovation into action. So I said that as a trader I got this information. It is a trailing indicator. Everybody said that it is a trailing indicator. So how I can make it is a forward indicator. So if this is the situation now, trend is down. Yes, trend is down. This information it has given. When the trend will become up, whether this value will tell me anything that when the trend will become up. So I'll change this 7859 to 7929 level. So once I change this 7929 level. So 7929 level. So once I change this particular value, I'll be getting, or means I'll be getting the levels where I can means 7929 level. So 7859 to 7929 level. So once I change this value, I got that yes, my 5-period exponential moving average now moved above the 10-period moving average. So this confirms above 7929 my trend is up. If this trend is up, how long this uptrend will continue? That is also I require. This how long it will continue. So for that I have taken the help of a spread. Spread is I have taken the difference between these things. You can also take the mean spread also. This is nothing wrong in that. convert all the spreads to positive, take the average, so you will get a mean spread. So you can say, if I go on changing this value, if once I place it 8153 level, so my spread, the current spread of this 5 period and 10 period comes to 34, and my maximum spread also 34. So I'll say that okay, this trend, uptrend, if it is continuing, it will go maximum till 8153. Once this is the confirmation point and the saturation point, you got it. In between, whatever the points, you can utilize the Fibonacci principle, Elliott principle, whatever you want, you can utilize and find out the in between point. So by this process, you can, my point of saying is, by this process, you can convert a lagging indicator to a forward indicator. So now, if you do this and if you find out this information of your trend, uptrend and downtrend, this, but I never use it. 40%, 47% of the people say that I do not know this principle and it's used. And 18% people are only saying that they knew these things. And 4% of people say that they never follow any of this principle. So this